Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 77, titled Buyers Have Rights, Sellers Have Obligations. We're going to give a real life example with CarMax Inc., which trades on the New York Stock Exchange under the ticker KMX, and we're focusing in on covered call writing. Now let's have a look at an option chain, the CBOE.com option chain for KMX. It's a 1 month expiration. When the stock was trading at 95.35, we're going to have a look at the 96 out of the money strike, which had a bid price of $2.40 or $240 for the contract. Now, if we take that information and feed it into the multiple tab of the Ellman calculator, we would see that the return on our option or RU, at least the initial time value return, is 2.5%. And that's 240 divided by 95.35. So for every one contract we sell, we're going to be generating initially $240. Now, since it's an out of the money strike, we also have a slight amount of upside opportunity here if KMX moves from 95.35 up to the 96 out of the money strike by expiration. That would result in an additional 0.7%, which means the total possible max return on this trade came to 3.2%. So that's about a 38% annualized return. So that's how the trade was initially structured. Now, option buyers, that's not us, we're the sellers, but the option buyers have certain rights. So let's have a look and focus in on the rights that the option buyers have, looking at it from the other side. Now, the option buyer is now controlling our 100 shares of stock, in this case KMX, per contract until the November 29th, 2019 expiration, which was 1 month out from when we looked at this option chain. And that's going to cost, from the buyer's perspective, $240 per contract. So the option seller, us, the covered call writers, would have to spend $9,535 to purchase 100 shares. So therein lies the advantage of buying options instead of the stock, because it's so much cheaper to control those shares. Now, the buyer has the right but not the obligation to buy those shares from us of CarMax at $96. That's the strike price in this particular contract. So what's the break even then for the option buyer? Well, if they're spending $96 per share because of their contract right, and they spent $2.40 on the option, that means the break even is $98.40 per share, $9,840 per contract. Now, the buyer can do certain things in this particular situation. The buyer can sell the option. They bought the option, they could sell it. And if they're directionally correct about CarMax and the price goes up, they could make a significant profit. The buyer can also exercise that option and buy the shares. That doesn't happen frequently, but it can happen. And the buyer of the option is the one that is controlling and the one that has the right. Now, the buyer can also allow that option to expire worthless. If the strike remains out of the money or higher than current market value of the stock at expiration, the option expires worthless. Then the buyer will have lost the entire cost to purchase the option in the first place. Now, if we were to break down the chances of exercise, it's actually only 10% of all options are exercised. That leaves 90%. Well, what happens with that 90%? Some people think that expires worthless, but that's not the case. 55 to 60% of options are closed. So in the case of a buyer, it becomes a seller, and that closes out the trade. 30% expire worthless. So the myth is that 80 to 90% of options expire worthless. That's really not the case. It's more like 30 to 35%. Now let's look at it from our perspective, the option sellers, as it relates to covered call writing. Well, we have a contract obligation to provide the shares to the option buyers if the option buyer decides to exercise at the strike price, which is the price that we've agreed to sell our shares for. That was our decision. By the expiration date, we also set the expiration date that we want the contract to end. So those two factors, the strike price and the expiration date, is our decision when we sell the option. But once we do, now the option buyer is in control. Now, by first purchasing the shares, that's what makes it a covered call trade. We are covered. We know our cost basis in that regard. We are protected. That's what makes it a low risk strategy. Now, by undertaking this obligation, we're then paid a cash premium. Hey, that's what covered call writing is all about, to generate a consistent cash flow. Now, as the option seller, we have certain choices. We could buy back the option and then close it. We still own the shares at that point, and we no longer have a contract obligation. So that's called buy to close after we sell to open. Now, we can allow the contract to reach expiration, assuming the option buyer didn't exercise early, which, by the way, is very rare. We can allow the contract to expire worthless if the strike ends up out of the money as expiration approaches. Or if the strike is in the money and we take no action, well, then the contract will be exercised and our shares will be sold at the strike price. So even though we have obligations, we do have a lot of control, and we make certain decisions. We could buy back the option, we can allow exercise, or we could take no action and allow the option to expire worthless. And then on the following Monday after expiration, we can make a decision as to what our next step is going to be. So let's summarize now. Option buyers pay for the right to control the shares at a much lower price than would have cost to buy the shares. Now, if the option buyer is directionally correct, there's an opportunity to make a lot of money because their cost base is so much lower than having purchased the shares themselves. Now, in general, this is a much more aggressive approach to option trading than the way I do it and the BCI community does it when we are on the sell side of options. Now, option sellers, us, are paid to make the shares available to call buyers. That is our obligation. Now we select the price, the strike price, and the length of the contract. That's our choice. I like monthlies. We have a lot of members of the BCI community that prefer weeklies. Most members of the BCI communities do not use long-term options, with the rare exception that some option traders in the BCI community like the poor man's covered call, where we purchase a long-term leaps option and then sell short calls against that. That's a small percentage of the BCI community. Now, on the sell side of options is considered a more conservative approach to option trading. And everybody has to know their personal risk tolerance before they decide on a strategy approach. So once again, let me invite all of you to visit the bluecollarinvestor.com website, where we have a lot of free resources. The top black bar of our web pages, you have the Ellman calculator, other calculators and files available for free. Have a look at our Beginner's Corner also. Two 8-part video tutorials, one on covered call writing, one on selling puts. And you could visit our store, where we have books available in all kinds of formats, including PDF, softcover, a few are available in hardcover. We have online video lessons with downloadable workbooks, a multitude of calculators that we've created, a trade planner, and online mentoring programs as well. And folks, that ends our BCI podcast number 77, Buyers Have Rights. sellers have obligations. Folks, I hope you enjoyed this presentation, and we have many, many more podcasts coming up the pipeline, so stay tuned for those. I want to thank everybody for taking the time to listen and watch this podcast. Hope you enjoyed it. Most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.